Hello everyone, this is Riya Singh, the Senior Research Analyst for Currency at Nirmal Bank. So let's look at what has happened into the Forex market. So we have received Fed minutes, and to say into crisp what the Fed minutes is indicating, that they have acknowledged that the factors responsible for the inflation are not getting down very fast. They are not seeing any provident evidence of the inflation coming down as fast as it rose towards the high levels of 8.9%. Now, what you can say from this statement is that, of course, the predicament is that the FOMC will continue with the rate hikes. There will be an aggressive stand. They have said time and time again, various FOMC members have come out and said time and time again that they are seeing interest rate hikes. They are ready to take steps in order to tame the inflation. Now, apart from the aggressive stand that they have taken in order to get the inflation down, they have also acknowledged the factor that if they do the monetary policy quickly, or they over tighten the monetary policy, it could result into the deterioration of the economic activity. This we have already seen take into consideration the two negative quarters that the US economy posted. Now, so all this is translating, and we are expecting around 50 bips rate hike again by the Fed in the coming months. The slowing pace of the when they'll slow the the rate hikes is something they are doing discussion around, but I think there is still time for it, and 50 bips could be expected into the next FOMC meet. Apart from that, we are seeing Euro USD again testing parity. It has actually went beyond parity, trading at 0.99 levels. So this has happened because of the deteriorating condition of the Eurozones altogether. There are posting of high inflation, there are posting of negative GDP growth. Apart from that, the energy crisis is playing a very major role in for the is playing a kind of a negative factor for the Euro USD altogether. And going forward, I think these conditions will worsen. There is talks of Russia again tightening its natural gas flow. It could get down the flows of the natural gas which through the Nord Stream that they were supplying to the Eurozone. Apart from that, there are talks that Iran, the sanctions could lift up from the Iran, but I think it will not happen soon enough for the euro to get some relief into the energy crisis. So energy crisis is what will bring down the Euro USD much or will let it stay near parity and trade around the same levels. So I think this is one of the reason what is contributing towards the stronger hold into the Euro USD, because if you look at the pound also, pound is not doing very well. There is a geopolitical tension, there is a political tension that is there. Apart from UK handling the energy turmoil, there is also high cost of living. There is elections that needs to be held, and if it is held, what will the candidate who will be selected, how they mold the policy going forward, because it will, whatever policy they go forward will also play a factor into the inflation, which the Bank of England is trying very hard to tame. All these factors, I think we could say that there is a need for the Bank of England to take much more aggressive stand rather than just going forward with the 25 bips rate hikes, because definitely it is not putting any dent into the inflation numbers or bringing down the cost of living. For the Indian rupee, the RBI has again sold $2 billion into the Forex asset, which we have seen the after effects into the yesterday and today's session. But I think it will only keep the Indian rupee towards a near 79.50, 79 levels. 79 is a very important support, and to breach that, lot of underlying economic factors needs to be changed. The inflation is cooling off from the highs, but there are other factors such as the widening trade deficit. There could be imports with respect to the wheat that could start. So this will again bring imported inflation towards contributing to a higher food inflation perspective. So I think going forward, RBI will need to time and time again intervene into the forex market in order to get the volatility under control. 79 levels will remain as a very important support, and breakdown of it is the probability seems lower. We are projecting that for Indian rupee, there should be it will be a buy on dips. So anywhere if you see RBI intervening and you are seeing a level dip around 79.50, 79.28, it will be a very good opportunity to go long into the USD INR for the target of 80, 80.50 level. So this is a short term target. For a long term, we are projecting it around testing 81, 81.50 levels. So for the Indian rupee, the strategy will remain to go long on dips. That's all for today. Thank you for joining in.